And if you will go ahead and introduce yourself again, Michaela. I am just so glad to have everybody here, and I'd like to get to know a little bit about you. So if you just take a minute or two and introduce yourself.
Yes, ma'am. My name is Michaela Smith, and I am from South Bend, Indiana. I am a mom of three, a stay-at-home mom of three, and I'm looking to grow my business. And I'm very, very excited for this budgeting class because it's literally right in time.
Oh, good. That's the best. Now, who's next? Who would like to go next? The only name I can pronounce is Marie. Do you want to come on and introduce yourself? Okay, I guess not. I want to introduce myself. I'm Debbie Langley, and I'm your host tonight. One of the reasons I'm doing this is because I am a mom of 6, and I've been an entrepreneur for more than 40 years. I also know how hard it is to make the transition from corporate to home-based income, and how to balance a family and a home and a business all together so that it function as one instead of as 3 individual entities. Tonight, we're going to talk about financial literacy and how to actually create a budget that will allow you to have financial freedom in the end. Are you guys excited?
Yes, very.
Good. I'm excited too. And you'll notice that I have my assistant, my personal assistant, Nell, on, and she's going to be monitoring feeds and things for me so that I can concentrate on what we're doing. And this is supposed to be interactive. So if you have questions, feel free to speak out or to put something in the chat. And Nell will be actually telling me if there's a question in the chat, so I don't have to watch it. And let's get started. I'm going to start with sharing my screen. And let's see. All right. So if you can see my screen, would you please raise your hand? You can use the little reactions just so that I know you can see it. All right, good. So one of the things I want to talk about is just basic terminology in finances, because if you don't know what those are, it can be very confusing when you have to start producing some financials for your business, or even if you want to buy a home. Anytime you want a loan, you need to know these terms. So an asset, what is an asset? A lot of people think their home is an asset, or their car. What are some other things that you might consider as an asset? What about your furniture? Your furniture might be, or equipment. In my dad's shop for his business, he had computers and tools. He had an automotive repair shop. He had equipment there. He had the lifts that went up and down that raised the cars to work on them. Those could all be assets. At the same time, those things can also be liabilities. So you have to balance them. And a liability is something that you owe money on. It's something that you don't own outright. Somebody else has a share of it. It's also things like loans and credit cards. Anything that you would put as an expense that you pay on is a liability. And so you have to balance your assets with your liabilities. And that's how you determine your net worth. So say you're really rich and you have $8,782,163 in assets. That's the things that you own outright, or that you could access the money without anybody having claim on it. Now, you also have in liabilities, that's money that you owe to somebody else, $588,512. So in this example, it's a really rich person, which is what we all attain to be, right? And their net worth, once you take away the liabilities, is $8,193.61. Now, that is a huge number and maybe doesn't seem realistic right now. So let's go in and make a profit and loss statement, which is something that you will have to do in your business, is show a profit and loss statement. But you can also do a profit and loss statement in your home with your family budget as well. And it's not a bad idea to do that every month and reconcile what you have so you know where you are financially. The biggest things to learn are assets, liabilities, net worth, and profit and loss statements, because those are things that are going to be terms that are going to come up a lot. A projection, we'll talk about that in a little bit. A projection is what you estimate you're going to be using as an expense or as income. You can do projections both ways. Does anybody have any questions on those terms? All right, so let's do our profit and loss statement. Say we're going to do our, actually, I mislabeled these. These are income. This one is income. And so what kind of sources of income might you have if you're for your business? Would you
Sales.
have sales? Okay. And you'd have sales of merchandise, and say you have 4 different products that you sell. We just say product 1. Boy, I can't spell today. And we're going to do a profit and loss statement for a single month. You can do this also for a year. But say our sales are going to be $2,500 for our income on product 1. Product 2, we are going to look at, let's see, somebody throw out a number for me. Let's say
High number or low number?
It doesn't matter. We're going to do 2 more products, and you can give me whatever you want. I've already got the formulas in here so that it will just pick it, throw it out there for us.
1,500.
Okay. And boy, my products are not coming up right. But well, we're just going to ignore that part. And then 1 more product. And what, let's see, this is a brand new product and we'll have $100 in sales. We also have sales because we just sold a piece of equipment. And from that, we got $5,000. So, any other income you can think of for your business? How about accounts receivable? You know what accounts receivable are? Accounts receivable are those things, those, like when you go to the doctor's office, if they let you charge, then what they've got is an accounts receivable. And say you have a vendor that you've extended credit to, and they're going to pay you that month, and they're paying you $929. So we'll put that there. That means you now have a total income of $10,829. Now, when you come down into expenses, you'll have, if you're in a building outside of your home, you'd have some rent or you'd have a mortgage. And let's say you have a small little office that you rent, and maybe you share with somebody else, and you're paying $500 a month for that. And then you have utilities that you share. And that's going to be another $150. But then you also have the expenses of your materials and supplies to produce your products. And so let's see, we've got roughly 9, 24, roughly $5,000 in profit in products that we have income, and hopefully we are keeping that at less than 50%. In fact, a third of the cost would be best. So a third of 500, we're just going to guess at, we have $1,300 in expenses. What other kinds of expenses would you have in your business? Do you have somebody helping you? Maybe you have labor and you're paying $800 a month for somebody to help you out. Oh, you got taxes. And your taxes are going to be, let's say $250. Actually, that's a little, because you have quarterly taxes and you have your sales tax. So let's say $350. That'll cover it all. And then something else you might have as an expense is repairs. And this month you had $25 in repairs. So we have a total income of $10,829, and we see our total expenses is $3,158. To come out with our profit and loss for our profit and loss statement, we're showing a profit of $7,671. That's a pretty good business, isn't it? Now, you'll want to do a profit and loss statement for sure on your business so that you know exactly what you're doing every single month. When you know your numbers and you're on top of your numbers, you will actually be able to grow your business faster and better, and you'll be able to make adjustments in order to compensate for like expenses that come up that you didn't know about, or labor costs going up, material costs going up. you'll be able to adjust on a monthly basis. So it's really important you know your numbers. Let's see, what else? It helps you to really know where you are. So even if you have a budget at home, then do a profit and loss statement, and you'll really know what's going on. I want to show you like some examples in a home, how you might be adjusting what you do for your budgets, because it's really important that we budget and we write down all the costs. One of the best budgets I've ever seen was actually done by Dave Ramsey. Raise your hand if you know who Dave Ramsey is. He is considered a guru, a financial guru, and he promotes no debt and no credit cards, no using credit cards, because the average person in the United States has credit card debt over $25,000, which is sad, because when we see some of the things that we're going to talk about a little bit later today, it's like stepping into prison and voluntarily stepping into a cell and closing that door and locking it. And so we don't want to be in that position. There's a difference between taking on debt that will make you money versus taking on debt that costs you. And one of the very first things I ever did when I started teaching my kids about finances is I had heard this interview on TV or on the radio with Robert Kiyosaki, and it's when he first wrote the book, Poor Dad, Rich Dad, Poor Dad. And he was talking about how a man using that only made minimum wage, and this is back in the 90s, so minimum wage back then was really inexpensive. Did you have something to say, Michaela?
I'm sorry, say that again.
Oh, I thought you had something you wanted to comment.
Oh, it was just the door opening. But yes, I read that book and I love it.
Yeah. So you know about doodads. Can you tell us about doodads?
Okay, say it one more time. I'm sorry, I got a crying baby.
Oh, okay. I'm sorry. Can you tell us about doodads?
Doodads?
Yeah. Do you remember doodads from that book?
I don't remember doodads.
Okay, well, doodads are things that you spend money on that have no real value. That's like if you buy a boat, it's a doodad. It costs you money, actually. Boat owners will tell you. All they do is put money into it. It's money for gas, money for repairs, money for storage. That is a big doodad. Other doodads we have in our lives are like buying the candy bars, or when we're trying to save, if we buy a shirt that we don't really need, that's considered a doodad. Now, if it's something we really need, that's different. That's a necessity. But wants generally are doodads. And in his book, he talks about how a man making minimum wage, back then it was like $3 and something cents an hour, could retire as a millionaire. And I was thinking, wow, that is something I got to teach my kids. What he does is he teaches about saving and not buying the doodads, so that you have more money that you can invest. And you invest it in good things like real estate. Real estate is a fairly safe investment if you do it right. Today's prices are crazy, and unless you really understand what you're doing, it's not a good place to put your money, because for investors that really know, they know things are going to collapse. And we're seeing signs of that and you just prepare to invest your money when it collapses, because you can get things pennies on the dollar. What we want to do is we want to set up our budget so that we are able to prepare to make investments like that. And we might not be able to make those right now, but we're preparing. And that's a good place. That's how we budget for financial freedom. When you are doing your budget, you want to put as much as you can down on your budget. There will be some things that you'll miss, but Dave Ramsey's budget is really, really comprehensive. And that's why I liked it. It was like, I don't know, 4 or 5 pages long in his book. We're just doing a simple one here. Contributions, that's your charitable contributions, your tithing to your church, whatever that you do there, that's in your contributions. Then you have rent. And I just took average rent in the area where I'm at. What utilities and gas can be, that's the gas for your car. How much gas does it cost you to drive to work, or your husband to drive to work? And then insurance costs. All insurance has really gone up in price. Then you have your repairs that you have to do, whether those are auto repairs or repairs for the home. You got to eat. You can do, as Dave Ramsey says, rice and beans, and conserve in what you eat, but still eat nutritious meals, so that while you're in the saving and preparing to invest, whether it's even in your business, you can be conserving while you're building your business. Clothing, especially if you have kids, $75 might not even come close to what you have to do, but you can make it work by doing secondhand stores or consignment shops. You can really get some very nice clothing there. In entertainment, and this entertainment, this is a doodad. Is that a necessity? Is that $150 we could use for maybe food or clothing or something else? This is just money that you pay out, and it kind of gets flushed down the toilet because it doesn't give you any return. So if you're tight on your budget, that would be one of the things that you might want to cut out. Then savings. And in this example, they're saving $251. We're going to talk about savings in a minute, but savings should be up here with contributions, because you need to pay God first and you second and make everything else work, because that's how the wealthy actually make that's a habit that the wealthy have, is that they pay themselves every month, every time they get a paycheck. And it doesn't start out with a lot of money. You could start out with just paying yourself a consistent $10 a week if you're paid weekly, or $10 from your biweekly check. And do that for a couple months, and then make it $20, and just keep increasing it in intervals until you're paying at least 10%. Gifts, we often can't, if we're on a budget, we can't get around gifts because we have family and we have to take care of them. But maybe we can cut down the cost of our gifts by making them. Sometimes the gifts, some of my most valued gifts for my grandkids and my kids are actually the homemade gifts that they gave. The one time my daughter-in-law took all the grandkids and she did salt dough and made handprints for me that I could hang on my Christmas tree. I've now repurposed those into a plaque but I mean, that was cherished, these cute little handprints, or putting together some pictures. One of the things that I like is, I don't know if you've heard of free prints. It's, you get 85 prints for like $4.95 in a month. And so I don't do it every month. I kind of save up what I want, and then I'll order 85 prints. And I can do all kinds of things with those. You can make a calendar, and you don't have to buy one of those calendars that you've done online and stuff. You could actually be putting the pictures on a page and assemble the calendars, print a free calendar off the Google. Gifts are next is vacations. When my kids were growing up, sometimes we went, what's a vacation? But vacations are important. You can do staycations, make them special, but you don't have to put money out. Maybe there is a trip that you need to do once a year to go see mom and dad back in another state. That would be something that you would want to budget in for, like the vacations. This family has credit card debt of $27,000. So they're a little above average. Their monthly payments are $1,200 a month. Do you think that is paying the debt down, or is that the minimum payment? That's actually the minimum payment. And so they're really not paying their debt down. And then they bought a car for $18,000, which is another $350 payment that they have. It seems like cars right now are so expensive. If you can repair a car and the repairs aren't more than what the car's worth, that it might be better to repair a car so you don't have a car payment. One of the things that millionaires do that a lot of other people don't do is that they don't buy new. They will use, rent, repair, they'll borrow, rent, or repair whatever they can instead of having to buy it. People that want to appear rich, they buy. And a lot of times you'll see people that get brand new cars every single, year or couple of years, or they're spending their money and not conserving it. And that's what we're talking about tonight, is actually looking at your expenses as a way to grow your wealth. Now you'll see I have extended some of these costs all the way across, because I know they're not going to change. Now my utilities, they change. The gas, it changes. These other things can change too. One of the things that Dave Ramsey does that helps to keep these things more stable is he uses an envelope system, where when you get your check, you get the money and you actually put the cash and you put it in envelopes. And you can only spend that amount that's in that envelope on that particular thing, and you can't dip into others. So it teaches training for or self-control in a way that a lot of people haven't grown up with. So we can see just off this first month that they are in the red, because they are actually $156.87 short. Now, it would be easy to take out this one and cancel all those subscriptions. Then they're only $6.87 out. And maybe, they take it out of their savings. Instead of doing $251, they start saving $240. So, you adjust it, but it's important to put all your costs down. Everything you might spend money needs to be on your budget. And as a special gift for being here, if you will put in the chat that you would like it, I will send you a budget that you can use that will have all the formulas in, so you don't have to add the formulas. It will just automatically do it for you. And all you'll need to do is put in what your categories are. Now, we talked about expenses, but let's talk about income. And with the income, here, Jonathan makes $18 an hour. Elise makes $22 an hour. They work 40 hours a week, which comes out to making $3,120 a month and $3,814 a month. If they want to actually bring in more income, so say Elise has her own business and she wants to bring in an additional $500 a month. If she puts in that 500, she's going to change this to 4314. And then look at what it does for their bottom line. They've got $351 more to spend. This combined take-home pay, it's showing what it is for your gross, or not for your gross, for your net. So this is a net figure. So after taxes, if your insurance is taken out of your paycheck, like excuse me, some companies will allow you to have insurance, but they take a certain amount out of your paycheck. You'll want to adjust this insurance number and then reflect up here that amount has already been taken out, and just do what your net check is. Now I want to show you about credit cards. Oops, wrong thing. So here is a listing of a family's credit cards and actual all their debts. They have 3 credit cards. Their interest rates are 18, 17, and 23%, which is very common for today. They went to the store and they bought some furniture, but they didn't have cash for it, so they put it on loan, and they took a loan out for 14% to buy their sofa. And they bought a leather sofa instead of something less expensive. And they own a home, so they decided that they wanted to do some home repairs and landscape the yard. So they took out a home equity loan of $9,000. In this instance, they have a car loan for $22,500. It's at 9% because they don't have that great of a credit rating, because they're using their credit at 75 to 80% of their actual limit. So that lowers your credit score. The more you pay off, the higher your credit score will go. And then they have their mortgage at 7% because they just bought a house and they paid $350,000 for it. It's only a small 3-bedroom, 2-bath, but they are creating an asset because instead of paying rent, they're actually got a mortgage. So let's look at what their principals are. And you can see that, and then how many payments that they're going to make. So on this credit card number 3, they're going to make, it's $840. They're going to make 12 payments at $99 a month. So in the end of that 12 payments, you can see instead of paying $840, they're going to pay $1,188. And that's their real debt. If they paid it off sooner, it would be a lower number. But using the full 12 payments, this is their real debt. When they do credit card number one at 17%, and they're paying $70.61, that increases their debt up to almost $1,700. And then look at what happens when you get down to their house. Well, let's look at the car. Instead of paying $22,500 for their car, they're actually paying $28,000 for their car. So do you think that they figured out when they bought that car for $22,500, that they were really planning on paying $28,000? I don't think so. Most people don't figure out what their real debt will be. And you get the little paper that says, okay, this is how much we're going to charge, and this is how much it's going to be if you don't pay it off, or if you just pay the minimum payment. In fact, how many of us don't look at it and we don't take into account that 5 or now 7 or 8 year loan that we take out on our car is going to cost us a lot of money in addition to what we agreed to pay. In their house, they actually have a 30-year loan. Now you can get a 40 and 45-year loan and still same interest rate. But they increased their cost of their home from $350,000 to $395,000. And so they've added $45,000 over the years to that cost. And what I want to show you in budgeting and how to get out of debt, because that's really important. If you have debt, if you're like the average American, you have debt and you need to get out. So we're going to develop a budget. We're going to cut up the credit cards and not use them anymore. Go to a cash system. You'll feel really rich when you use a cash system. And it's amazing what that cash in your hand feels like. And you don't feel like you're being deprived, because you are actually putting the money out. And when you take that envelope out and you're paying for groceries and stuff, you are conscious of your numbers. And it affects how you really choose to what you put in your basket. And in this example, the person is finding an extra $50 a month that they can put towards debt. And we're going to start a rollover plan. And in our rollover plan, we have the same credit cards, mortgage loan, and car loans, all those loans. And what we're doing is we're going to add $50. And I don't know if you can you guys see the top where it says the first debt, which is credit card number 3, because it's our smallest debt. We're taking that $74.63 that we are paying. I think I didn't transfer everything, but this still works. And we're adding $50 to it. So this is, we're paying $124.63, and we're going to pay it off. And we pay it off in just 7 months. And then once we get it paid off, what we're going to do is we're going to then attack the second credit card. And with the second credit card, that's the $1,500. We're going to take the $74.63 plus the $50 that we were paying, so $124.63, and we're going to combine it so that it comes up to $195.24 that we're going to pay off. And we remember we paid it off in 7 months, so in month 8, and we've been paying the same amount, the minimum payments here, but now we're going to add what we paid off into it. We're not going to put it back in our budget. We're just going to roll it over and keep paying on our debt. And in 13 months, we have paid off 2 credit cards. Huge, huge. Next, we're going to attack credit card number 2. And even though it is a high interest rate, we want to go from the smallest amount to the biggest amount in order to get, and we're talking about principal, that we want to start with the smallest and then attack the biggest, because it will be motivating. I mean, as you check off those credit cards, it is amazing how exciting that is. Go, wow, that one's gone. And just a minute. And we're going to roll it over in 21 months, so less than 3 years, or less than 2 years, we have totally paid off 3 of our credit cards. And now we have that $321.77 that we've been paying towards the credit card. We're going to now apply it to our furniture loan. So instead of making the payment of $139.49, we're going to be making a payment of $461.26. That will knock it down really fast. In fact, in just over 28 months, or just to be 29, less than 29 months, we will have paid that off and started attacking the next one, which is our home equity loan. And we just keep going and doing this. And I want to show you here, after 28 months, we have $615 that we're applying each month towards the home equity loan. And after 40 months, down here at, we're putting 1,082 all the way up. Let's see, get my screen to go farther. Here, we are now putting $2,180 towards our mortgage every month. We have doubled our mortgage payment, and we're paying it off. How long do you think it will take to pay off our house? Any guesses? Go down here. 11.8 years from the time we started paying our first debt until we own our house free and clear. Then you take that same amount that you've been paying towards your bills, and you start paying yourself towards paying the for investment, preparing to buy real estate or investing more in companies that are going to, when you spend the money, you're going to get an ROI back. Does anybody know what an ROI is? An ROI is your return on investment. So if I invest $100,000 into something and I get $15,000, I get $115,000 back at the end of the year. My ROI for the year is a 115% because I got it all back. Now, if I put out 100,000 and I only get 25,000 back, I'm in a negative ROI because it cost me. Now, there's calculators that do all of that, and we could set up a spreadsheet that would help you figure it out. I figure when I invest in real estate, if I'm making $200 a month minimum, that I'm still getting a good ROI on my return because I am on a positive cash flow. It's not costing me money. And you want to take your business into a positive cash flow as quickly as you can. It can be difficult if all you're doing is putting money out for ads, putting money out for materials. But there are ways that you can structure it that you will not have to be putting everything out, so that you can start making a little bit of money every month. So we want to work on that. I want to show you how putting just that $2,000 a month into a savings, what that looks like for, say, a retirement, because that's one of the concerns we have as a business owner, is how do we pay for our retirement, because we don't have the company provided 401ks. So at 12 years, this is where we're starting. We're getting 0 interest on our deposit of the $2,180.17. After we paid for 15 years, that same exact amount, we haven't changed it, we now have $96,994.50 in the bank. We are earning monthly $783.59 in interest. So that's money that we are earning that we didn't work for. If we go down to 18 years, from the time we started paying our debt off, this is 18 years. So it's another 7 years after we paid our last debt off. We are now making not only the, we've got $221,857 in the bank, but if we get down here to this point, just under 19 years, and look, we are actually making more interest than what we are actually putting in the bank. Our deposits are earning more than what we have actually contributed. So now we have in the bank $268,000. But look at this, our $2,000 deposit is now equal to $4,377.61 in interest, and our principal combined. So we are doubled. We are more than doubled just by continuing doing this and using the interest that we're earning. And this is in an investment that's giving us 10% back. By the time we get down here, and we are, I mean, at 25 years of doing this program from the start, we've got $700,000 in the bank. And all we've done is continue the same habit. And we're actually earning double the interest that we are contributing our principal, which is kind of cool. You get down here to 30 years of working this plan, which you guys are, it's possible for me, I'm going to be old by that time, but it's a plan that still works. You got $1,335,000 in the bank, and you only contributed $475,000 of that amount. The rest is all interest. Who thinks that's pretty cool? Would you like to do that? I think that that is an entrepreneur's dream, because you can change this figure of the amount that you're contributing, but the principle applies still the same. And it's the, you want to be getting more, making your money work for you. At 30 years, almost 6 times the amount of your contribution is how much interest you're making. That's pretty cool. Does anybody have any questions that I can answer? Does it feel like you were getting hit with a fire hose? Well, we're down to the end. And if you would like to have a copy of the budget, please put it in the chat and Nell will make sure that we get it to you. Also, I'm going to let you in on a secret that we're going to announce tomorrow. And that is, instead of a workshop in 2 weeks, I'm actually doing a prize draw. And that prize draw is, I'm going to give 8 weeks of coaching away to somebody. There will be a registration, just like you had to register tonight. And you have to be present to win. But you can get 8 weeks of my program free. And I will work with you the exact same way I work with my paying clients. And I would love to have you guys be a part of that. But you got the sneak preview. Tomorrow we'll make the big announcement out on the group. If nobody has any questions, we'll go ahead and end our workshop. Is anybody okay? Then thank you for joining us, and we will see you later. Have a great day. And thank you for giving me your time.